Be thought about who the hell is buying all of this. Every month we're seeing billions and billions and billions every week come into the COMEX. And guys like Vince Lancy, who are no dummies, and he's a smart dude, one of the smartest in the industry, and he says, look, 85% of the gold that's being bought by the central banks is not being reported to the IMF. They're bringing it in ways like China going in and buying dore and concentrate, as Sean Kunkun will tell you from Dolly Varden, from all of the miners in Latin America and in Mexico, pulling gold and silver out of the ground before you even call it that, because it's in concentrate and dore form, shipping it back and refining it themselves. Well, that doesn't trigger IMF reporting. It's under 999 fine.
Global markets are shifting in ways most investors are not prepared for. Behind the headlines, billions of dollars worth of gold is quietly flowing into the COMEX every week, much of it hidden from official reporting. Central banks are accumulating through unconventional channels, buying dore and concentrate directly from miners, using proxy banks, and leveraging sovereign wealth funds to bypass IMF disclosure. At the same time, mainstream institutions once devoted to bonds are now reallocating into precious metals, a clear signal that confidence in government debt is waning. This surge in unreported and unconventional accumulation suggests something larger, a potential reevaluation of gold and silver at the very core of the monetary system. AndySchectman, a leading voice in the precious metals industry and CEO of Miles Franklin, has long emphasized how these hidden flows are reshaping the global financial order. His perspective reveals not only how central banks and treasuries are maneuvering behind the scenes, but also why silver, recently declared a critical mineral, may be on the verge of a historic breakout. Now, we present the clips from AndySchectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Cut rates in an environment raising a rising inflationary environment where the CPI has stayed above their target 2% for over 53 straight months, where they've revised, you're going to talk about the unemployment numbers, they've revised almost 500,000 jobs year to date as is, let alone all the revisions that we saw before that. And so I think that it's a weak market. It's the realization that we have chosen inflation over austerity and getting our balance sheet in order. And maybe the world is finally waking up to that holding treasuries, when Jeffrey Gundlach, the bond king, says, let's just, all of these guys, whether it be Morgan Stanley, Goldman Sachs, Jeffries, or Jeffrey Gundlach, saying we're going to take money off the bond table and reallocate it to gold. That's when people should stand up and take note. This is how these people made their mark, and now they're backing away from it. I don't know. I think maybe that is the tipping point, is that they're speaking to institutional level people. They're not speaking to mom and pa. They're speaking to their institutional clients. And, Michael Hartnett's letter is not cheap, and the analyst for B of A, and to go to 25, 25, 25, 25, who's ever heard of that until now? Be thought about who the hell is buying all of this. Every month we're seeing billions and billions and billions every week come into the COMEX. And, guys like Vince Lancy, who are no dummies, and he's a smart dude, one of the smartest in the industry, and he says, look, 85% of the gold that's being bought by the central banks is not being reported to the IMF. They're bringing it in ways like China going in and buying dore and concentrate, as Sean Kunkun will tell you from Dolly Varden, from all of the miners in Latin America and in Mexico, pulling gold and silver out of the ground before you even call it that, because it's in concentrate and dore form, shipping it back and refining it themselves. Well, that doesn't trigger IMF reporting. It's under 999 fine. Or buying it from other locations around the globe through maybe proxy banks or sovereign wealth funds that don't trigger it, and using artisanal and local miners, and bringing it in not through the central bank channels, so it's not reported. All I'm saying is that the biggest money in the world has been doing this for a long time and getting more creative in the way they're doing it. But what is different now is that who the hell's bringing it into this country? If I had to guess, now again, could be a guess, I would say it's the Treasury Department under the guise of the Exchange Stabilization Fund, where it can be quiet. Don't tell anyone, it's for national security. And now I think you should interview Tom Luongo as well. He has a very interesting take, and that is that Trump understands or believes that it is the European aristocrats who were behind any perception of election interference and a color revolution in this country during the previous administration. And he's out to get the Bank of England and those banks who are massively short in London. Now, all the gold that's been coming back, could it be that it's been covering the short positions of the banks here in the States who, when they short on COMEX, they go long in London, they bring it back, they call it tariffs. It's not tariffs. It's never been about tariffs. It's been about reshoring. So maybe if you want to walk that fine line of conspiracy and reality, and this is coming more from Tom than it is from me, but I think it's a very intriguing idea, is that all that gold coming back, maybe it's being used to cover the short positions of the banks in the States with the idea that it's going to go to the Treasury in terms of their gold acquisition for whatever their plans are with gold revaluation or pegging it to the bond market, as I believe, and to cover their balance sheet. And we're this close away to some sort of a systemic moment in London where the inventories, in particular of platinum and silver, are down to less than 1 day's worth of trading. And if these continued delivery requests happen, you're talking an existential threat for some of the biggest banks in Europe, and Trump is out to get them, is what Tom is saying, out to get the Bank of England and out to get these aristocrats that are the bankers in Europe by having some form of a delivery default in London that would very quickly trigger a systemic chain reaction that could bring down some of the biggest banks in Europe, as the banks in the United States have quietly covered. Now, could that happen? Don't know. All I'm telling you is the amount of gold coming into the COMEX every single week is unlike anything anyone has ever seen, and we are now net importers of gold for the first time really ever, other than World War II, when everyone sent us their gold as part of the World Reserve Standard. And, you know, since then, maybe 1 or 2 months here and there, but every other, the trend has been net exporters for the United States as far as gold is concerned. My whole career, which is going on 36 years, what Vince is saying, how much of it is coming in ways that doesn't trigger it that way, using proxy banks, using sovereign wealth funds. And the interesting thing about it is that, you know, when you talk about the worthlessness of the mainstream media, who really hasn't done anything in this country but foment divisiveness, I mean, you would think that when the United States becomes a net importer of gold, going back to any time since World War II, where the amount coming in is that we know of north of 150 billion since November. And you know, there's a lot more in that coming in. But the questions aren't even being asked, who's doing this? And although obviously markets are meant to have anonymity attached to them, but where is really mainstream? Why is it that you have to hear from alternative media that this is going on, and what does it truly mean? I would guess that some of it has shown up. To your point, it did show up, but not all of it is being reported. If the idea was to use gold and reintegrate it into the monetary system, we're seeing it across the global south. We really are. We're seeing it massively being reintegrated into the plans, the settlement system of the Shanghai Metals Exchange, expanding their vaults throughout the whole Belt Road Initiative. The first one was built in Hong Kong. The next one is under construction in Saudi Arabia, so that they can trade their local currencies over the M-Bridge technology and settle imbalances like that in gold, where China has now, in an effort to internationalize the yuan in the Shanghai Metals Exchange, made digital yuan immediately convertible into gold, not converting back to dollars. This is going to be the rails of their payment system. I believe that gold will have a different role in the United States, but equally as compelling in terms of its monetary future. And any way you look at it, I just think that gold will be reintegrated into the monetary system. And the fact that the government just made silver a critical mineral here in the United States, we're seeing massive amounts of silver too, like literally billions and billions and billions and billions and billions every week coming in. And now it's a critical mineral. They just put a floor under the price as far as I'm concerned. Things are different, Kai. For the first time, the focus isn't on U.S. treasuries. In fact, the people who promoted it are saying maybe back off and buy gold. The focus isn't on these traditional assets that are now changing, and it just feels different at a level that would perpetuate legitimacy, that would accentuate legitimacy instead of fighting against the wind forever. It's like we got the wind at our back right now from the highest up of the food chain in terms of finances. That silver is going to rip the lid off of the market, as he goes on to say. It is revising sharply upward. in their mind, and that the technicals of both price and long-term momentum, he believes, are telling the market what is already occurring and what's about to occur. A repricing, he says, of silver's reality, whatever that means. So I've never heard him so bullish on silver. He was saying that if it follows the previous cycles of 2010 and 11 or 1979 and 80, you can get as high as $100 or $200 on this move. But it's interesting, if you take the 45-year cup and handle of silver, which is now literally almost a double cup and handle, and 45 years, one of the most powerful technical moves, period, in technical analysis, the way that you would figure out where the next stop is and or where the target would be, and even if this analyst who was looking at it didn't know what it was, is you take the top of the cup in 1980, goes down to the bottom in the 90s to $4, goes back up to 50 in 2011, comes down and is making that final push. When it gets through that 50 level, you take the distance from top to bottom, which would be 50 to 4, that's 46, add it to the top, 50 plus 46, your next target's $96. That's what Michael is saying right here. 100 plus, he thinks, if compared to 2010 and 11, that's where we'd end up.
The precious metals market has shifted from a quiet phase to explosive demand, with retail and institutional flows converging in ways not seen before. Gold and silver imports into COMEX over the past 9 months have reached unprecedented levels, aligning with growing institutional recognition of gold as a core component of investment portfolios. Major banks, asset managers, and market strategists now openly suggest that gold should hold weightings of 20% to 25% in traditional portfolios, an extraordinary departure from the long-standing norm of just 5%. This change underscores a profound revaluation in how wealth is preserved during periods of fiscal instability. At the same time, cracks in official data highlight the severity of the economic backdrop. Inflation remains far higher than reported, job creation is continually revised downward, and government debt continues to balloon at an unsustainable pace. With real returns on treasuries now profoundly negative, global capital is quietly pivoting toward hard assets. The scarcity of freely available silver on international exchanges, combined with its recent classification as a critical mineral, adds further urgency to the trend. The financial order is entering a stage where real price discovery may finally emerge, carrying implications that extend well beyond metals markets. Let's get back to the interview.
Well, as far as the retail market in precious metals, it's gone from a very slow trickle over the last several months to fire hose type of volume. There's an awakening. And maybe it has something to do with all the metal that's been imported into the COMEX over the last 9 months, levels that we've never seen before, anyone has ever seen before. Now that goes hand in hand with what we've been talking about for a long time with the central bank buying. And then you start to see things like the CIO of Morgan Stanley saying, well, maybe a 60-40 stock to bond allocation isn't really good. Maybe we should go 60-20-20, 60% stock, 20 bond, 20 gold. You have Jefferies, one of the head traders at Jefferies, saying now 6,600 is what they're expecting. You have Michael Hartnett from Bank of America said, well, no, it should be 25, 25, 25, 25, 25% stock, 25% bond, 25% short-term treasury, 25% gold. You have Goldman Sachs saying if the Federal Reserve gets one whiff of the Federal Reserve losing independence, Goldman Sachs says this, but what's Stephen Mirren, who filled that vacated spot, but the author of the Mar-a-Lago Accord and advisor to Trump? What independence? So there's a lot of, I think, signals pointing to the very, very big money, the institutional money, is moving in this direction. Jeffrey Gundlach, the bond king, comes out and says 25% gold is not too much of an allocation. Now, my whole career, Kai, 5% was acquiesced by the financial advisors to appease their clients who were into gold. 25%, when the biggest money in the world, from Tether to the commercial banks to the central banks to the bond king, saying, look, we made our mark in traditional assets, but you might want to weigh up your gold allocation Something's different, honest to God. And then you add on all the imports into COMEX, which is 5 feet of snow in Death Valley in July in terms of an anomaly. Every month, billion over billion over billion over billion in gold and silver coming into COMEX. Something is really very different. For the very first time in 35 years, I mean that sincerely. Something's very different. You know, the markets, for as far back as I can remember, find these big numbers like gold at 2000, and it would just keep hitting it and hitting it and hitting it. And when it goes through, it's gone. It just depends how many times does it take to challenge it. And I would argue that, 50 is just psychological. If you go back and look at 1980 and 2011, it was a cup of coffee long that it hit 50 for both times. And so what kind of resistance really is there other than, mostly psychological? And, Kai, who the hell knows what real price discovery is in gold and silver? It's not even debatable that the central banks of the West have held down gold and silver for a long time. When real price discovery happens, because I believe that you can only manipulate a market for so long by pushing it in the direction that it is going. And it was easy for the West to do this for a long time. But you have a whole bunch of players around the globe that are coordinated, motivated, sophisticated, wealthy. They know what we're doing by holding down the paper price. They're standing for delivery, largely in London, in order to beat us at our own game. And now the folks in the West here get it. The big traders, either they were tapped on the shoulder and said, start bringing this shit back, pardon my French, and you can call it tariffs all you want to fool the public. It's not tariffs, it's about reshoring. Get it back. And that's what they're doing. It's easy for people like you and I and the people listening to this show, Kai, to get wrapped up in recency bias. We've been beaten up so badly over so many years in an environment that was counterintuitive to logic and our belief structure. But our belief structure and logic and mathematics have a way of playing out over time. You can't hide from math. And a lot of this is just simply math and logic, and it's finally playing out. I think the sky's the limit. So will it bounce through 50? Eventually. Will it do it first time? Maybe. Maybe not. It's irrelevant. I think ultimately sky's the limit once it does get through, though. Well, it should. I mean, I think what you can see by the CPI numbers and the Bureau of, we should just call it the BS instead of the BLS, and their massaging of employment numbers is that, I mean, you take two things away. Number one, inflation is far higher than we are being told. Just ask John Williams of shadowstats.com. He'll say at an 8 to the 3% that we're talking about, that's 11%. And the unemployment numbers are far worse than we have been told. And it's interesting, they keep issuing these numbers. The market reacts, what a great economy we have. And then they quietly revise it down to the largest revisions ever. And, month over month, they're taking away, hundreds of thousands of jobs that we thought were created. No, not really. Our model was wrong. Sorry. But the market's already reacted. I think that it's becoming obvious that we are heading towards stagflation, which is a slowing economy connected to higher prices and inflation. And it's really the most painful part or most painful outcome. Higher prices, lesser and lesser growth. And I think it's a frightening realization that the job market truly is cooling down. And so now the Fed has to decide, what do we do? Do we lower rates? And if we continue to lower rates, what does that signal to the rest of the world? That we've given up on any hope of austerity. We just tighten a little bit and the whole dang thing blows apart. So are you going to sacrifice the employment market and then reignite the inflation engine when we haven't even hit our target for 53 straight months? And the number that we tell the public is a lie anyway. So what do you do? And this is the quandary that the Federal Reserve is in. And that's why I think you'll see what we see in Canada and in London. And that is a series of short, the front end of the market driven down through rate cuts. But the back end, no. We're going to go the other direction because we're not going to hold any duration treasuries of yours without a much higher rate. In other words, can the Federal Reserve, through yield curve control the back end? Sure, they probably could, which, again, is something that should frighten everybody. But if not, the market is going to demand much higher rates for the risk of holding our debt which continues unabated. Our fiscal irresponsibility is just an absolute embarrassment. And creating still nearly $1 trillion every 100+ days, that's not going to work for the rest of the world. And you get to a point where if Trump is able to lower rates on the front end low enough, you're going to get the very big money that is acquiesced to putting it into short-term treasuries, where now the rate that they are trying to get to of 2% on the federal funds rate is less than the CPI number of almost 3%. They will not stand for that. And there's your 1% running to gold. And we're already there from a real standpoint with inflation. The dollar's down 11% this year. So a 4% short-term treasury halfway through the year or 3/4 of the way through the year is giving you back 3%. The dollar's down 11. You're negative 8% real return. Gold and silver are both at or above 50% return for the year. This is the trend that we're seeing globally, where the biggest money is always 3 steps ahead of the crowd. They've been shorting or selling, pairing off their treasuries and buying commodities. This whole run up, when everyone else, you speak of vindication, when everyone else said we were stupid, I said, no, we're not stupid. Look what the most well-informed traders in the world are doing quietly before the rest of you idiots catch on. And I don't mean idiots. I just mean the people in the mainstream who laugh at people like us who see things differently, instead of having an open mind and say things are changing and we cannot go around the world doing what we do and have massive fiscal irresponsibility without there being consequences. And you are beginning to see those consequences in the lack of demand for the U.S. Treasury. So I got a good idea. Let's come up with something called the Genius Act. And we can use that to fund the front end of the Treasury market with synthetic demand through stablecoin creation. I mean, we're getting to that last end stage game where things are going to start to get real interesting, and I think really fast also. Now, of course, my focus would be on gold and silver, the real value, and platinum. The real value is probably in platinum and silver, although the premiums on the pre-1933 gold coins are the lowest I've seen in my career. There is great value. The real value is in silver. The word is asymmetrical, low downside, massive upside. The LBMA is almost out of all of their free float of silver, which can just like that trigger contagion and a massive spike in price. Billions of ounces are coming, or dollars worth of silver are coming into the COMEX every single week, and the U.S. government just reclassified it a critical mineral. Food for thought, but it doesn't have to just be in my universe. I'm sure there are a lot of people out there who would want to look at cryptocurrencies as a way to shelter from a devaluing dollar. The bottom line simply is this, is that if you are saving dollars, you have a very high probability of going broke in terms of your purchasing power. We've seen that already with 11% decline, but look at what Stephen Miran, the architect of the Mar-a-Lago Accord, who is now on the Federal Reserve and is still an advisor to Trump, his whole idea is to devalue the dollar in order to reshore gold. What did Vice President Vance say? To reshore manufacturing, excuse me. What did Vice President Vance say? Triffin's dilemma, being the world reserve currency, is no longer a good deal for us. It is a subsidy on the consumer and a drag against manufacturing. It's really not a good deal for us. What does Trump say about a strong dollar? Sure, it's great, but you sure don't do a lot of business or have a lot of tourism. They're telling you they want to devalue the dollar. It's the only way to pay off the debt. It's the only way to have any hope of manufacturing success. It is the only path left to take. Now, there's other stuff to that next time when we get more time, we'll talk about it. But a devalued dollar is in the cards, and so do the best you can to accumulate assets, whatever that means to you. Stay away from holding your wealth in dollars. It's a sucker's game right now.
The transformation unfolding in gold and silver markets is not a passing trend, but a structural reordering of capital. With debt burdens compounding, monetary policy stretched beyond precedent, and global institutions quietly shifting into tangible assets, the forces driving this cycle are bigger than any single event. Silver's scarcity and gold's renewed role as a monetary anchor point toward a financial reset that could catch many off guard. As this story unfolds, staying informed will be crucial to staying ahead of the curve. If you value insights that cut through the noise, make sure to like this video, subscribe to the channel, and share your perspective in the comments below. Your engagement helps us continue bringing you critical updates.